Everyone says index investing is the simple, easy button for building wealth. But what if simple isn't the same as easy? What if the biggest risk in what's supposed to be the simplest strategy is actually your own brain? Okay, let's get into it.
So let me tell you about Kevin. In early 2020, he thought he was going everything right. He wasn't trying to get rich quick, he ignored the hype, and he put his life savings, a solid $180,000, into a simple total stock market index fund. He felt smart. He felt safe.
And then, March 2020 hit, and in just 3 weeks, Kevin watched his portfolio absolutely collapse. Reading about volatility in a book is one thing. Watching your net worth just evaporate by a third in real time, well, that's a whole different ballgame psychologically.
And this is the moment where it all went wrong. See, intellectually, he knew he was supposed to stay the course, but the fear, it just became overwhelming. At the very bottom of the market, when the panic was absolutely deafening, Kevin hit the sell button on everything.
By selling at the absolute low point, Kevin did something devastating. He turned a temporary, on-paper loss into a real, permanent one. And of course, when the market came roaring back just a few months later, his money was sitting on the sidelines. His story is, well, it's a powerful cautionary tale for every single one of us.
The final bill for that one single emotional decision. $62,000. Just gone. That's money that will never grow for him, never compound. It's a permanent scar on his retirement plans. The index fund did its job perfectly. He didn't.
Now here is the thing. Kevin's story isn't some rare one-off mistake. Not at all. In fact, it's so common that it actually has a name. And it explains why most investors consistently fail to capture the very returns their own investments generate. It's what we call the great investor illusion. This mistaken belief that just because a plan is simple, it doesn't require any psychological effort. This brings us to the core of the problem, something called the behavior gap. It's the measurable financial cost of being human when you're investing. It's all the money we leave on the table because we let fear and greed take the wheel, which almost always leads us to buy when prices are high and panic sell when they're low.
And look, this isn't just a theory. The data is crystal clear. Study after study from firms like Morningstar consistently shows that the average investor, the average person, underperforms their own funds by a pretty big margin, year in and year out. That gap you see there, it's real, it's persistent, and it is incredibly costly. So what does that gap actually mean in real dollars? Let's put it into perspective. A 1.7% annual behavior gap, and that's a conservative estimate, by the way, on a $500,000 portfolio over 20 years will cost you an absolutely astonishing $400,000 in lost wealth.
So what causes this? How does smart, well-meaning investors like Kevin keep falling into this same trap? Well, it often comes down to 4 hidden risks that, frankly, nobody warns you about when you sign up for this so-called easy path. Let's break them down.
Trap number 1, you think you're diversified, but you're really not. When you buy an S&P 500 index fund, you think, great, I own 500 companies. But what you might not realize is that you're making a hugely concentrated bet. Right now, the top 10 companies make up nearly a third of the entire index. If those few giants stumble, so does your entire diversified portfolio.
And if you think that sounds like a crazy scenario, well, just ask investors in Japan's Nikkei 225 index. Back in 1989, it was also dominated by a handful of invincible companies. Those investors had to wait 35 years, just to get their money back. Being all in on a single country's index is a massive and often overlooked risk.
All right, trap number 2 is ignoring the silent killer of wealth, fees. I mean, look at this. The difference between 0.03% and 0.50%, it looks tiny, right? It seems totally insignificant. It's so easy to just dismiss it as pocket change. But it's not. Because over 30 years, that tiny little fee difference can silently siphon off over $165,000 from your portfolio. A lot of so-called simple products, like some target date funds or robo-advisors, they bake in these extra layers of fees for convenience that, honestly, you could replicate yourself for a fraction of the cost. In the last 2 traps, they are purely psychological. Trap 3 is just underestimating the sheer, raw discipline it takes. Your boring old index fund will always be underperforming something, whether it's tech stocks in the 90s, crypto, or your neighbor's hot stock tip, which leads directly to trap number 4, fighting that constant nagging urge to chase whatever is hot.
Resisting that temptation isn't a passive thing. It's an active, difficult decision you have to keep making over and over and over again. Okay, so knowing all this, how do you actually defend yourself? The key isn't about finding a better, more complicated fund. It's about building a psychological shield that protects you from your own worst instincts.
And here are 4 really practical steps to build it. First, write down your plan when you're calm and rational. Pre-commit to it. Second, truly diversify. Look beyond just the S&P 500. Third, spend 5 minutes and check the fees on everything you own. It could save you thousands. And finally, the big one, automate everything. Take your emotional finger off the trigger.
This brings us to what I think is the most crucial idea of all. We have to stop thinking of index investing as the easy path. It's not. We need to see it for what it truly is. It's the correct strategy that just happens to be psychologically very, very hard to execute.
You want to hear something wild? A famous, or maybe infamous, study by Fidelity looked at which of their accounts performed the best over a long period. The winners? They belonged to people who were either dead or who had forgotten they even had the accounts. Why? Because they couldn't meddle, they couldn't panic sell, they couldn't mess it up.
And that right there is the ultimate takeaway. The strategy itself, it's incredibly simple. A kid could understand it. But actually executing that strategy year after year through market crashes and bubbles and manias, that takes a level of behavioral discipline that, frankly, most investors just don't have.
So let's just leave it with this thought. Acknowledging that the strategy works is the easy part. The real, difficult key to success is building the systems and the mindset to protect your wealth from its single greatest threat, which, as we've seen, is almost certainly you.